We keep on talking about the rand. I'm sure our viewers in the other 52 African countries are sick to death about hearing about the South African rand. But why is it important for us to focus on the rand and indeed on other emerging market currencies?
Well, I don't know that they should be sick to death. We are, after all Africans. So let us just try and rejoice in our leadership role in this case, and I think that is really important. But where one has to focus one's mind on this, it's not rand strength, it's not basic, wonderful South African economic fundamentals. It's the very weak dollar. And remember that we're all measured against the dollar, and all our international trade, not all, majority, is measured in dollars. All our exports, our base commodity exports, are dollar priced. Gold is dollar priced. All these things mean it's the dollar which takes the lead in determining the rand exchange rate.
Okay, let's talk about emerging market currencies in general. What we've seen with the equities from emerging markets is that they've risen exponentially, the highest levels now since 2008. What impact does that have on currencies coming out of the non-developed world?
I think it does have an impact, because emerging markets are seen as the growth centers, perhaps not right away, but they're the areas which are going to have quicker growth, because the developed nations are probably stuck in a 2 to 3% growth era, whereas the emerging markets are more likely to be looking at the 4 to 6% target ranges. And I think that they are the basic commodity producers. Amongst them are the oil producers, and I think that is what is inclined to direct capital flows towards those markets.
Now, many people say when you look at emerging markets currencies, their tradability, they don't really fare differently to established currencies, the G7, the dollar, the euro. What we need to do in evaluating emerging market currencies is look at monetary policy, those fundamentals you referred to earlier on. How do we compare? If you looked at the BRIC countries with South Africa, with Nigeria, how do we compare?
Well, we have sound monetary and fiscal policies. That is the first consideration. We also have very deep, liquid financial markets. It is possible to move significant sums of money in emerging market terms through the rand market. And I think what we find is that we may find an international player with a position in Argentina, and Argentina pesos, for instance, say, hell, I can't move them. Tell you what, if emerging markets are going down, I'll go short of the rand. It's a convenient vehicle to use. And because of that, we get extreme volatility with extreme changes in the inflows and outflows in the very short term.
Talk to us about the trade-weighted system, because apparently that's what helps to mitigate against the volatility. That's what helps to stabilize some of these emerging market currencies. How does the system work?
We should really measure ourselves against a basket of currencies of our major trading partners and have that weighted according to the volume of trade. And we do have a trade-weighted rand, or a nominal effective exchange rate, and if one looks at that, one says, oh, actually the rand hasn't strengthened nearly as much against the basket of trading partners' currencies as against the dollar itself. And this is a problem. But because all of the international markets are focused on the dollar, that tends to get the center of attraction. But it would be a far more sensible and reasonable way to measure a currency.
Okay, exchange rate policy, quite controversial.
Yes.
Many people saying South Africa's Reserve Bank should intervene in terms of, some say have a more liberal exchange rate policy, others say, constrain it, because we don't want market forces influencing the rand beyond the strength that we're seeing right now. In countries like China, which is powering away as a global giant, they are quite strict about the exchange rate policy, often manipulating, we're told, their currency in favor of their exports. What approach should emerging markets be taking?
Well, China can afford it. They've got the biggest reserves in the world outside America, and so there's a different category there altogether. We can cover about 6 or 7 months of imports. That's all. That means we've got relatively low level of reserves. And the Reserve Bank, what do they call it? Leaning against the wind. They take a little bite now and again as and when they can feel that it's appropriate. But in the year to March, the Reserve Bank lost over R1 billion on currency moves against the reserves. Whew, who pays for it? We, the taxpayers. So we can't encourage them to go too quickly on this intervention. It is very expensive.
Yeah, but what hasn't been done, Ian, which I think on the other argument that we're putting forth, is the argument that says that we are tired of seeing people playing the market, that all the money, the inflows that have come in are all going to the market. They're not going to the real state of the economy. So the debate we're having is how do we stimulate the real set of the economy by switching the short-termism of these flows into a long-term player so that they chase not only the short-term movements of equity markets, but they chase the growth of the business and invest in the business. And the agenda that we're discussing is is it worth a while for us to use a Malaysian type or a Chilean type method whereby we punish or we tax those that are short-term, that at least if you keep your money for a year, you can take it freely, but not the ones that you take it for 2 days and take away. So we want to make sure that we can change the behavior of the short-term investors into a long-term players. We've got any views about these discussions that we're having within South Africa?
Well, I'm glad you mentioned that. There is an answer, and that is abolish exchange control. And you say, wow, that's extreme. But you know, it has to be done, it can only be done when the currency is strong, so that there's the least accumulated losses at that stage. There'd be a knee-jerk reaction. We would find the rand would stop appreciating and it could weaken a little. First mission accomplished. In the longer term, we'd probably get a return within a year or two. Look what happened in Kenya. That's what they had. They had a big bang of forex relaxation, and they found that within a year they were getting fixed direct investment, and that made a huge difference to the country.
Lumkile, let's raise this issue or let's elaborate on this issue that you're raising, the taxing of capital inflows into the economy. It's happened in Brazil, yes, and it hasn't worked really well. And as Ian is suggesting, you need an economy and a reserve position where you can countenance outflows if indeed that is the reaction, the knee-jerk reaction to some of these interventions. South Africa doesn't have substantial enough.
Well, in fact, what we saw, I mean, the studies have shown very clearly, in the case of Malaysia, Mahathir Mohamad's leadership between 1997-98, in the height of the Asian crisis, as well as in Chile, that these work very, very well. They work very well in the sense that you cannot measure them in months, as what doing in Brazil. Brazil has just done it now. So you have to see whether the behavior changes. And the behavior of firms and investors takes a while to change. So I think the jury for me on Brazil is out there. I think it's too early to call. Because we saw with Mahathir, people were very critical of what he did. But 3 years later, the IMF, the World Bank, everyone else, the scholars, were all arguing that they did the right thing, because what happens is that the Malaysian economy stabilized and rebounded very quickly compared to its counterparts, and it continues today to do very, very well.
What about the intervention that's been suggested and that other experts suggest, which is accumulated reserves where the central bank comes in to defend the currency?
Well, that's what Ian was talking about. That costs us a lot of money, because you can never lean against the wind. The wind will blow you. It will come at 400 k's per hour. It will blow you away. So the best thing to do is to have a policy that's transparent. The market may not like it initially, but it's transparent. Every dealer sitting in London or elsewhere knows that in South Africa, your money has to stay for 1 year. Otherwise, if you take it earlier, you'll be taxed so much. And that's transparent, that everyone knows what the rules are. But once start doing leaning against the wind, there's dangers.
Okay, Ian, I don't know whether you want to add to that?
Yes, just what a large part of the inflows that we've had have been looking for yield. The interest rate differential between, say, America, where the base interest rate is 0.25%, and South Africa, where it's 5.5%, 6%. And the interest on our bonds goes at 7 to 8%. US bonds vary between 0.5% and 2%. Gee, of course they want to come in here in a stable currency just for the return in what they see as a low economic growth environment. Let's rather get that interest return.
Low economic growth environment, and that's the operative term at this stage. We've seen South Africa's exports, or the export performance, drop by 20%, and consequently that's what's been attributed to the overvalued currency, which apparently is overvalued, or overvalued foreign exchange, which is now overvalued 5 to 15%. The central bank can't really intervene on getting this economy working at optimum level and pushing up those exports. But a lot of these emerging markets are export-led economies. So how do we overcome a global situation where demand for exports has dried up, or a situation where output in factories is lower, in order to try to defend the currencies?
I suggest instead of starting at the far end, we start at the near end. What we need is to control our input costs. Now is the time for manufacturing manufacturers, miners who are going to export to invest in new plant and machinery and equipment. Buy it when the rand is at its most advantageous rate to import, the lowest input costs. What that does in due course is to lower the unit production costs for longer. If we wait until we're doing well in exports because the rand is weak, we can't afford to replace that plant, and that is a problem. And also we have to get used to the idea we cannot have, as we saw in yesterday's employment data, 19% average increases year on year and no increase in productivity. We will never be a strong force unless we bring these into play. So that is where I think we have to manage our future.
I think more importantly, Ian, is also that the government must create the right environment, because at the moment we know very well that the behavior of government on the mining licenses, as well as in other areas such as Eskom investment program and Transnet, that those are heavy or high cost adders in addition to the wage that Ian talked about. So going forward, there's a huge disincentive for firms to invest on new capital, because the cost of doing business in South Africa is so prohibitive and so difficult.